Welcome to The Explainer. Today, we're going to tackle a massive economic puzzle, why the world's money seems to flow completely backwards, and how that's created a really fragile system that, well, puts all of us at risk. All right, let's just dive right into the heart of the mystery. Every economics textbook will tell you that capital, money for investment, should flow from rich countries down to poorer countries, right? That's where it's needed most, and that's where it can get the highest returns. But in the real world, for decades now, we've seen the exact opposite happening. This whole puzzle is so well known, it actually has a name, the Lucas paradox. It's this simple observation that huge, vast sums of money have been flowing uphill from the developing world, the South, to the wealthiest nations in the North. And understanding why this happens is absolutely key to grasping the huge financial forces that have shaped our world in the 21st century. So to solve this paradox, our first real clue is a phenomenon that just grew to epic proportions in the years leading up to the 2008 financial crisis, and it's a little something called global imbalances. I want you to think of the entire world economy as just a giant financial seesaw. On one side, you've got these super saver countries. They're earning and saving way more than they spend at home. And on the other side, you've got the super spenders, who are consuming and importing way more than they produce. And this, as you can imagine, creates a massive imbalance. Now, here's what's really fascinating, the timing. These imbalances weren't always this crazy. They kind of started growing back in the mid-90s, then they just exploded in the 2000s, and they hit this historically high peak, right as the 2008 crisis hit. That is not a coincidence. And yeah, they've shrunk since then, but they are far from gone. And here we go. You can see the key players in this whole drama. The Super Savers Club, well, that includes major exporters like China, Germany, and Japan, plus oil-producing nations that are just flush with cash. And on the super spenders side of the seesaw, the United States is the undisputed heavyweight champ, with the UK and parts of Europe right there with them. So what happens when this seesaw gets so dangerously out of balance? Well, you get a global financial system that's built on a pretty risky and deeply codependent relationship between the savers and the spenders. Let's just zoom in on the two biggest players here, China and the United States. You had China with its massive export machine, earning just mountains of US dollars, and then you had the US, which was consuming like there was no tomorrow, running up these huge trade deficits that, of course, had to be paid for with borrowed money. And this kicked off an incredibly powerful feedback loop. See, China didn't want its own currency to get too strong and hurt its exports. So what did it do with all those dollar earnings? It plowed them into the safest asset it could find, US government bonds. This massive wave of money pushed US interest rates down to rock-bottom lows, which then made it incredibly cheap for American consumers and companies to borrow and spend, often on more stuff made in China. The cycle just kept feeding itself. So the crucial point here is that this created what economists call a bad equilibrium, or you could just call it a toxic dependency. The US economy got hooked on cheap credit from China, and the Chinese economy got completely dependent on the US to buy all its products. The scary part? Neither side could just walk away without causing a massive shock to their own economy and the entire global system. But hold on, the story doesn't end with just the yearly flow of money. To get the whole picture, we have to look at a country's entire balance sheet, its total international net worth. And this brings us to a concept called net foreign assets, or NFA for short. Honestly, the easiest way to think about it is like your own personal net worth. It's the total value of everything a country's citizens own abroad, minus the total value of all the domestic stuff owned by foreigners. It gives us a snapshot of whether a country is, overall, a creditor or a debtor to the rest of the world. So how does a country's net worth change over time? Well, first you start with whatever you had last year, your opening balance. Then you add or subtract the money you made or lost through trade that year. A surplus makes you richer, a deficit makes you poor. Pretty simple. But here is the twist, and it is a big one. The value of the assets and the debts you already have can change all on its own. How? Well, things like stock market swings, or, and this is the really surprising part, changes in the currency exchange rate. And that right there brings us to the hidden factor, the secret key that can totally change a country's entire international financial position almost overnight, the simple movement of its currency. Okay, let's use France as an example. Back in 2021, France's net foreign asset position was negative 750 billion euros. That means, on paper, it was one of the world's major debtor nations. It owed a massive amount of money to the rest of the world. Now, normally, you'd think a weakening currency is bad news, right? But what if I told you that for a country like France, having the euro fall in value could actually make its international balance sheet look better? It sounds completely backward, doesn't it? Well, it's true. In that same year, the euro depreciated against other currencies, and that change actually improved France's net position by a staggering 19 billion euros. It's like it magically wiped away a chunk of its international debt, and nobody had to pay a single cent. So how on earth does that work? Well, it's all about what currencies your assets and debts are in. See, like a lot of advanced economies, France's foreign assets, we're talking stocks in US companies, factories in Asia, they're all priced in foreign currencies. But its debts, they are overwhelmingly in its own currency, the euro. So when the euro gets weaker, the value of those foreign assets, when you convert them back into euros, suddenly goes up. And at the same time, the value of its euro-denominated debt stays exactly the same. It is a super powerful valuation effect. Okay, so let's pull all these threads together. We started with a paradox. We followed the money through these global imbalances, we saw the toxic dependency that it created, and then we uncovered the hidden power of currencies. So, what's the final verdict here? When it comes down to it, this strange uphill flow of capital really isn't much of a mystery once you see the system it was propping up. The savings of developing nations were, in effect, financing the consumption of the developed world. And this created a deeply interconnected but ultimately really unstable global economy. And even though the 2008 crisis forced some of these imbalances to shrink, the underlying dynamics, they haven't gone away. And that leaves us with one final and kinda unsettling thought. That seesaw is still there. That fundamental split between the world's savers and its spenders, it's still shaping our financial system. The global economy is still resting on this fragile balance, which just begs the question, what happens if, or maybe when, it tips again?